Hey everyone, thanks for hopping on to the Wednesday session for Making Multifamily Money. It's going to be a very small, intimate group unless people join later down the road. But what I want to briefly talk about is how to make $1 million during a recession. So, what I was kind of talking to Jenny about before I hit record was, 8 months ago when the stock market was doing well, crypto was doing well, everyone was so hyped up about investing in real estate. But now that, the stock market's going down, crypto is going down, and interest rates are going up, a lot of people kind of shy away, from investing in stocks, crypto, and real estate, especially. But it's slightly ironic because during a recession, that's when the most millionaires are made, but it is very counterintuitive, right? If you follow the herd, if you follow the sheep and do what everyone else is doing, then you'll just kind of be, average for the most part, right? That's the way I view it. So, like, if everyone's going left, I go right because the majority, if you follow the majority, most of the times you're just following what, middle class people are doing. But if you want to become wealthy and become upper class, then you have to kind of have to think a little bit contrarian and do the opposite. So, like the way I phrase a recession, high interest rates is so, about a year ago when interest rates were what, 3 to 4%, people couldn't buy because every time a house went on market, people were overbidding and you end up getting outbidded and there's just such low inventory. So it's hard to buy, right? But now with high interest rates, it's the complete opposite. There's higher interest rates, there's more inventory, but now people are too afraid to buy. So it's a little bit counterintuitive. And the way I phrase it is it's kind of pick your poison, right? Do you want low interest rates but more competition, or do you want higher interest rates and less competition? And, if you think about real estate with a long term mindset, then, like it doesn't matter whether it's a buyer's market, a seller's market, high interest rates, low interest rates, you just constantly buy real estate, right? So for me, I don't even really pay that much attention. But what's nice about a recession is, a lot of the buyers or sellers, they're less, they call it less arrogant, less cocky now. So they're willing to negotiate, right? Before I used to send out letters and they would say, hey, I want like whatever, $3 million for this apartment complex that's maybe worth 2 million. And then I would, run my numbers and say, hey, the bank wouldn't, finance this based on your financials. The debt service coverage ratio is not 1.25 or greater. And I just would say, well, if you do creative financing, like, seller carry first, if it's owned free and clear or subject to or master lease agreement, if there's existing debt, I don't mind overpaying by $1 million, but give me my terms. Right. And then even despite that, they say no, like, go screw you. So then I just move on to the next person. But now that it kind of flipped and it's kind of a buyer's market now, I think people will be a lot more open, right? Like, it's kind of funny, like brokers, when I was buying homes, brokers would write me off. But now all those brokers that wrote me off, they're calling me because, business is maybe more difficult, right? People aren't as bullish in buying real estate. So, it's just kind of funny seeing that way. And, when you kind of think of it that way, like, in a sense, it's like, I guess I'd rather have it easier to buy real estate. I pay a high interest rate, but if you buy it right, despite high interest rates, like, you can always refinance your interest rates down the road, right? And the way I preach about buying multifamily, and all three of my deals that I have in multifamily, my two apartment complexes and a mobile home park, like, to be honest, I'm adding value, right? And I'm doing multiple cash out refis. So, let's just say I finish my 26 unit. I just finished renovating maybe about 10 units and I rented out five. And I was able to double my rents from 350 to 700 with these newer renovated units. So, my apartment complex is going to double in value. So it went from about half a million. I bought for half a million. I put $200,000 in. Honestly, I think it's going to be worth 1.5 million. And, if I refinance it in the next 6 to 12 months, my interest rate, it's going to be like what, 7? 7% if I refinance now, but maybe in about a year it might be closer to 10%, with our current trends right now. But to me, I wouldn't care because like I would still do it. That just means I pull out less money, right? Because you need a good debt service coverage ratio of 1.25. Interest rate's 10%, then I'm going to need more cash flow to suffice that 1.25 debt service coverage ratio. But I'll pull out my money, buy more real estate, and then like whatever in 5 more years from now, hopefully the rents go up. And if you look at the statistics at the last two crashes, so the most recent two is in 2000 with the dot com and 2008, which was the greatest housing recession ever. The one thing that didn't change was rents. So if you look at the data, the rents in the year 2000 and 2008 actually stayed the same or slightly increased by 1%. So just think about that, right? With interest rates going up, a lot of people who maybe pay rent, they pay a lot of rent. Like if you live in the Bay Area, some people pay 4,500 to 5,500 in rent a month. And if they didn't buy a house before and interest rates are higher now, they're probably not going to buy now, and they're going to be paying rent still to landlords. And when the landlords raise the rents, they're stuck, right? Because it's either pay the rent or move somewhere else, and it might be higher. So as long as the rents stay the same or go up, the value of apartment complexes will go up or stay the same. So that's why I consider apartment complexes recession resistant, because regardless of recession or a bull market, rents stay the same or go up. So that's why I think this is a great time, with all this uncertainty and all this fear on the news. If you turn on the news, you all hear it. It's every day you turn on the news, it's stock market's going down, crypto crashed, interest rates are rising, more inventory's coming. There's probably going to be foreclosures coming, to be honest, for people who bought real estate poorly, right? I'm specifically talking about Airbnbs. A lot of people bought Airbnbs based on DSCR loans, and they might have overpaid for it or had pro formas of really good rents. But during recession, who's going to go to Airbnb? I mean, unless you're really wealthy, right? Unless you're very affluent and wealthy. But for your average, you know, average income earner, what do you cut out when during a recession? You cut out, going to Airbnb and travel. So, I feel like there's going to be a lot of opportunity. And then now, like, it's even more important to do a direct mailing campaign and get off market deeds, because now the sellers know, like, if they watch the news and they don't live under a rock, they know that the housing market crash might come, home prices are going down, and when people come from a place of fear, they're more likely to want to negotiate with you and be more reasonable, right? So, for example, that same guy that wanted 3 million, that's maybe worth 2 million. Maybe he would, whatever, go down to the price of 2 million, or if he wants to do creative financing, then maybe I'll pay him like 2.5 instead of 3, right? So this is when you can really start to negotiate, when people come from a place of fear. So I think this is kind of, if you have the liquidity and the money ready to go, this is the time to double down in terms of getting off market, sending out letters, generating off market leads, and mastering and negotiating creative finance on top of that. So you have all the tools under your belt, right? You get off market leads, you can do creative financing to give them their price, because, or if they don't do creative financing, then they just get a lower offer. So this is kind of the time where, like I said, if you buy the property right, you add value. I don't really care what the interest rate is when I do my cash out refi. So I'm gonna pull my money out, buy more real estate as people are more fearful. And then when the interest rates go down in whatever 3 to 5 years, then you cash out refi, or you do another refi and lower your interest rate. So that's what I kind of recommend to everyone. For all the students, I typically recommend, when we get a loan for commercial, you want about 7 to 10 year term, ideally. So I locked mine in at 4.3%, 10-year fixed. So, like, I'm doing a lot of value add right now where I triple the value. But if I didn't even want to cash out refi, I just can sit and coast and I have a really good interest rate. So, or if I want to do a cash out refi, then I can pull some money out. So, it just gives you a lot of options out there. And um, kind of another point that I like to hit on, especially during a recession, is like, myself included, a lot of real estate investors, we invest in real estate because we want to retire from our W 2 job, right? That's the end goal for me. I work full time as a pharmacy director and I do want to retire early, but like during a recession, I know when there's good deals out there, it makes me more motivated to work because I can have at least a consistent stream of income coming in. And on top of my, you know, W 2, you want to build other businesses to get more income, then use that income to buy more real estate. So to me, it's like it makes the most sense to like, um, just having a W 2. Don't leave it too soon as you scale a real estate portfolio, and then once you just have enough real estate, you just can leave your day job and just do whatever you want. Right at that point, you don't need to buy any more real estate if you don't want to. So that's just kind of my 2 cents. So basically, what I would do, if I was starting from scratch um, today during this time is, obviously number one is I'd get educated, right? You can learn on YouTube, you can go and learn on podcasts, you can read books, you can buy a course, you can join a mentorship. You can buy my course or anyone's course that resonates with you. Learn how to generate off-market deals using a direct mailing campaign, right? So, for me, I use PropStream for my data, and I use Yellow Letters Complete for my outsourced lettering campaign. If any of you guys need my referral links, I can just reach out to me. I can give it to you. For Yellow Letters Complete, I have my contact that helped me set up my direct mailing campaign. So that person can help guide you and how to structure your letters and how you want to be strategic to get the best response rate. So if you're investing in like Oklahoma, like where I do, not as big of a market, typically about 3% response rate. But if you're like investing in California, Texas, Florida, North Carolina, the hotter states, then it's about a 1% response rate. So if you I send about 300 letters a month, that's about 3 to 10, callbacks a month, right? And from there, what's kind of nice too is like most of my letters, based on my data, we're targeting the older mom and pop owners who are like, upper 60s, they want to retire. And now they're seeing their retirement nest egg drop down, right? Because, like, if they're hoping to retire on $1 million from this apartment complex, but with the housing market recession and possible crash coming, maybe it's 800,000. So now they're afraid to lose 200,000, but now they might be willing to maybe sell their property at 900,000. So basically, you save 100,000 and they make 100,000 more. So this is the kind of time when you strike and you can negotiate, build trust, build rapport, and you can give them their price. But like I said, it must be creative financing again. So like I said, I would get off market leads, build trust, pitch and educate about creative financing, and try to just save up as much money as possible. And then when you buy the real estate, obviously have reserves, right? So I think during this time, and that's something I struggle with when I was scaling, was because I was scaling so rapidly to 90 units, I didn't have as much of a reserve. So that's why I stopped, and I'm starting to rebuild up my reserves again. I have multiple lines of credits. But on top of that, I also want like cash, right? You want to have, at least 6 months of reserves. Ideally, I kind of dipped into it scaling. So I'm trying to rebuild that back. But between all of that, and then, if you have a long term outlook on real estate, like this recession wouldn't really matter. Like, is this going to matter in like 10 years? Like, most of the people that I know, like, kick themselves because they didn't buy more real estate from 2008 until like 2013, right? Like, everyone now was like saying, oh, I wish I bought more real estate. Like, I remember in the Bay Area, in like San Francisco, every year the houses went by 100,000. So like from 2008 2013, a house went up by like 500,000. So um, I would definitely kind of double down on all those three aspects. And then you have to buy, value add real estate. Like, that's how you really make money and grow your wealth, right? So you have to, number one, buy it right. Number two, execute a value add strategy. So what is that? You can do renovations and raise it to market rent. That's what I'm doing, right? I buy C-class apartment complexes that are old. I'm gonna renovate it really nice, right? New kitchen, new luxury vinyl plank flooring, new bathroom, and then I can raise the rents to market rent, and my property manager will tell me, right? So I literally just, like I said, rented out 6 units at $70 a month. But and then from there, once you increase the value, it doesn't matter. Like, if you increase the value by 500,000, but the value of your property went down by 200,000, I mean, you're still ahead by 300,000, right? So that's what's nice. Like, it's in your full control if you do value add. So that's why I like forced appreciation, right? That's what you have in multifamily. You have forced appreciation, but in single family homes, like my single family homes, they're all dropping down, like by at least one to $200,000. All my ones in California dropped by $100,000 to $200,000. All my apartments are going up, right? So that's why, like, for me, it just makes more sense to eventually scale up to apartment complexes. And single family homes is great, if you have appreciation, but when there's a recession, it doesn't go down, it goes down. It doesn't cash flow as well, especially in California. So, um, like I said, if you get one or two properties, for however long the recession lasts, like, those two properties can kind of set you up for the rest of your life. Like, it can help you retire from your day job. You can leave a legacy for your children. You can have the option to do whatever you want, right? It's freedom of time and options, and that's what ultimately we want. And also, like you said, leaving a legacy for your kids, if that's what you want to do. So, that's why I said it's a really great time to buy real estate and to learn all these strategies. And the key is just don't go do it yourself, right? You want to learn from people. You want to follow a proven system, and you want to leverage someone's. If you want to get to 90 units like me, then just follow someone like me, and then you can leverage my resources, leverage my systems, and get there as well. Get there faster, hopefully. Um, so yeah, just briefly went over that topic. I guess I can open it now to some questions here. Um, Let me just first answer this question in the comments, then I'll get to Jenny. So as a landlord, how much should you raise rents to not lose any tenants? Yeah, so that's a good question. And so, like, I'll share my experience first. So every time when I took over my 26 unit apartment complex and my 20 unit apartment complex, the first thing that people would know is when you take over, people stop paying because they know that, oh, there's a new landlord, right? When you take over, you get to give a notice to all the tenants that, hey, there's a new owner, there's a new property management company, this is how you're going to pay your rent. So they know that, like, okay, this new landlord's going to come in. I've been getting lower rents, because the previous landlord hasn't raised rents in like 3 to 5 years. So I'm going to milk the situation, especially during the holidays, right? People want to save some money for Thanksgiving and Christmas to buy gifts, so let's not pay the landlord, right? So they're not going to pay, and they know they're going to leave, right? In Oklahoma, it's a 15-day notice to leave. So usually they won't pay, and they usually just leave without me giving them the 15-day notice. They just leave because they know that they're just milking it, so they'll leave, right? That's one group, right? So that happens of it. So once it's vacant, obviously you can fix it up, renovate it, whatever, and raise it to market rents, right? And then the next option is your existing tenants, right? The ones that stay, and maybe they're, slightly under market. Um, Generally, so a lot of times when you take over, if they're month to month, then obviously you can come in and raise the rents right away. What I've kind of been told by my property management is, obviously they're not going to raise it to market, right? Because it's not newly renovated and whatnot. But whatever, let's just say they're like $300 under market. Like in my apartment complex, they're about 300 under market. So I typically would raise it by like 100, and then just send them a letter, right? Usually we'll say, hey, like, the plan is we want to fix up the apartment. We're going to renovate some units. We're going to touch up some landscaping, maybe fresh paint and coat on the outside, add a playground. Just share whatever you're doing so that, when you raise their rents, you're giving a reason why, right? Like, you have to come in and make money, but you're gonna making all these improvements, and just know that, hey, like the vacant units that we're gonna rent out are gonna be like $300 more, but since you're a loyal tenant, and assuming they're a good tenant, hopefully, we're just gonna raise it by 100, and we hope you stay, and then, or you have the option to move to a renovated unit when it's ready. So, um, but typically, I defer that to the property manager that you're working with. Just ask them like, oh, like how much can we raise the rents? Because for if I didn't do any renovations, I still could have raised the rents by about 150. So I could have raised it from 350 to 500 about with just doing basic turning of the units, just touch ups, repair things here and there, and maybe replace things that are just way damaged. So, you can do that. And then for the full renovation, that might cost like, let's say $2,000, and you still raise the rents by 150 versus a full renovation might be 8,000 to 10,000, and you can raise it by, to the market rent. So that's what I did. So we raised rent to some tenants, and some tenants were all bills paid. So I had to cover their gas bill, and the gas bill averaged to be like about 100 to 150 depending on the season. So during winter it was 150. So what we did was we didn't raise their rents, but we made them pay for their own utilities. um, so yeah, so Jenny, yes, to renovate, so what I did was I have one bedroom, one bath. So what I did was I actually ripped out the whole kitchen. Like, you don't have to rip out the whole kitchen. You just can like repaint the cabinets sometimes if they're still good. But I think we want to reconfigure the cabinets to have a more open concept. The more modern open concept instead of having tall kitchen cabinets. So I ripped out the whole kitchens, replaced it with shaker cabinets. So you want to use shaker cabinets because number one, they're easier to build. Number two, it's more cost effective, and number three, it's just easy to install and assemble. But if your contractor can get you, wood cabinets for the same price, then obviously you'd want to do the wood cabinets because they're more durable. Like, you just can paint and touch those up. So I did the whole kitchen. So the kitchen's the best bang for your buck in an apartment complex, right? Like when you walk into an apartment, all you see is the kitchen. That's every home. So, I did new kitchen cabinets. We did laminate countertop. So laminate is okay in Oklahoma. I know in California, like granite or quartz is very popular in California, but laminate's cheaper. So it goes like laminate's the cheapest, quartz is second cheapest, and granite is the most expensive. So typically it's either laminate or quartz. So we did laminate countertops. We did LVP flooring throughout the whole unit. So we did it in the kitchen, the living room, and the bathroom, in all the bedrooms, because that's very like tenant friendly, renter proof. And we did bathtub kits that you can buy at Home Depot. So it comes like with a bathtub and the walls. So it's really nice, and then you just get a new bathroom vanity. So I averaged around $8,000 to $10,000 per unit to renovate. And that's everything brand new. So so in my mind, I put in about $8,000 to $10,000 per unit. I'm only going to renovate about half the units. So a general rule of thumb is you don't want to renovate more than half, because when tenants come in, you want to give them options, right? Like, do you want a nicer option that's more expensive, or a premium unit, or do you want a more affordable unit, right? So that way you appeal to a larger demographic. So, like for example, like in my 20 unit, so dumb thing I did here. So I assumed that I assumed my property manager knew I was only gonna renovate 5 units, and then whatever other units that weren't being renovated, they should have just cleaned it up, touched it up, and rented it out. But then my property manager assumed I was gonna renovate all the units, so I ended up having 5 units that are done renovated, and I have like another like 6 units that are like, we had to evict tenants or they just left, and nothing was done with them because they assumed that it was being rented. So now I have like 11 units that I basically need to like rent out. So we're starting to rent them out like aggressively. But that was stupid because like I didn't rent out 6 units, and that's $500 per unit on average. I mean, that's like $3,000, right? Um, so, that's $6,000 a month in cash flow, and that's the difference between me breaking even or being negative versus making positive cash flow. So that was my bad. I didn't communicate clearly that only these 5 are renovated, and then these others that become vacant as people leave, you can just do you don't have to do full renovations, do basic make readies, and then at that point, you can rent them out. So that was my stupid mistake that I made. Right. So live and learn from real estate. So hopefully you don't make that same mistake that I did. And then when people rent, when contractors renovate, in the ideal world, you want to renovate one unit, finish it, rent it out. The reality is the contractor is going to renovate like 4 or 5 units at the same time because it's easier, right? You bring your flooring guy, you put floor in all 5 units. You bring your kitchen guy, you put kitchens in all 5 units. You paint all 5 units at the same time. So it's easier for the contractor, but then what sucks for the investor is like now you have 5 units that you gotta aggressively rent out. Versus if you did one at a time, it'd be a little easier. So that's something that I kind of learned the hard way a little bit. Where like I was hoping like, oh, just do 1 to 2 at a time and then get on with it. But they ended up just doing like 5 at a time, and at this point I'm just trying to rent them out. So hopefully that answers that question there. So next question is, yeah, how to prepare for the recession? How can you differentiate themselves from every other investor who direct the mail? Yes, great question. So to prepare for the recession, like I said earlier, have a lot of cash ready. Um, a little bit more than usual. So I like to have at least a 6 month reserve on hand, but maybe during a recession, I might bump it up to maybe 9 to 12 months. If I had kids in a family, I might be more towards that like 12-month range. But if you don't have any other obligations and it's just yourself, maybe 6 to 9 months. And then also get your lines of credits ready, right? So if you have whole life insurance, you can get a cash value line of credit against that. If you have a stock portfolio, you can get a line of credit against that. If you go through First Republic Bank, you can get a personal line of credit for $100,000. So what's nice about this is it's kind of like an additional emergency fund, right? It's like hopefully you don't have to use it, but it's kind of like a big credit card that you can use. Or if maybe things are costing more than you need, then you have that money ready, right? So you have money fast and able to pivot. And then the next thing is like when you underwrite, you want to be very, very conservative. So like for example, when I teach my students underwrite, it's you take the gross income and then you assume the expense is 50%. And at this point, you ask your mortgage lender or mortgage broker what the terms are. So probably in this day and age or today, it's probably 25% down at least. And 30-year amortized loan and probably I don't know 6.5 to 7% interest at this point. And a little bit against my initial philosophy, but maybe doing a larger down payment. For me, I was very focused on scaling. So I wanted to leverage as much as possible. But as I start to accumulate more, pieces of property at like 90 units and doing this heavy value add, I kind of feel like I don't need to scale as fast because like 90 units is quite a bit, right? I mean, just for one person. So I feel like I might do a larger down payment than I'm used to. And it's better now with interest rates being higher, right? Because if your interest rate is like 7% and you do a larger down payment, you're essentially locking in a 7% return on your money, right? Like you can't get 7%. I mean, if you invest in the SP 500, the average is 7%. So for me, I'd probably consider doing a larger down payment, right? Instead of doing 25, whatever you can do. You can do 50%. And like I said, you're already locking in that 7% interest rate return on your money. If you down a little bit more, you just lose a little liquidity, right? So you can down more money and then pull a HELOC on that investment property because you have equity in there, right? Between your down payment and maybe if you buy it under market value, you have some equity there. So you can still access that money. You can make a large down payment, lower your mortgage payment, and then pull a HELOC on it. So you have the best of both worlds, right? So that's what I honestly would do if I were to buy an apartment now. And then I think, as I mentioned earlier, just know creative financing very well. Because with creative financing, you can negotiate all your terms. You can do, interest only payments. You can negotiate your interest rate. You can negotiate, how much you pay. And then as long as you cash flow, you're good, right? And then the next thing is like, just buy properties right. Like don't overextend yourself, right? And buy properties right. Like don't have shiny object syndrome or those rose colored glasses and overpay for a property, right? Unless it depends on your situation. Let me take a step back. Like let's just say I own a business that makes me so much money that I just need real estate as a tax write off. At that point, they can overpay for real estate and the tax benefits alone off their business income makes them saves them enough money that it doesn't matter, right? But for someone like me, or if you work a W-2 and you don't have a business making a lot of money, then you can't necessarily overpay for things. Um, so that's the first part of your question. Second part is, so for direct mail. So um, honestly, a lot of the feedback that I got from my letters is they liked how personable it was. So the strategy that I teach the students in my course and how to prepare the letter. So in my course, I give all the students my letter templates actually. So they have my letter template, and I help them. The only thing they change is a paragraph about themselves because obviously you're not me. But typically, you want to make it very personable and very relatable, right? So a lot of people in letters, they try to be fancy, like, oh, I'm a big capture, whatever syndicator fund LLC, right? It's a fancy big name, but like you just want to come off as like this everyday person, like, hey, I'm just Steven. I'm just trying to buy real estate to provide for my family so that I don't have to do whatever. I can take care of my kids. I can pay for their college. I can leave my day job. You just come off as very relatable, average person. Like, I just want to provide for my kids. I want to provide for my family. I want to, retire and spend time with my family and friends. Right. So that's why I used to say my story. So, like, for me, for example, I'll just say, like, in my paragraph, like, oh, I'm Dr. Stephen Nguyen. Pharmacists are technically doctors. And I'm just slowly looking to scale a real estate portfolio so that I can plan for my take care of my family in the future, right? So if you have kids, talk about your kids. Like I have 8-year-old kid, 8-year-old boy named Jordan, and a 5-year-old daughter named Jade, right? Just talk about your family and what you're trying to do. Just come off very relatable, and that really resonates with the mom and pop owners. So so how I strategize my letters is number one, you want to use imitation size envelope, so it's smaller, it looks more inviting. Number two is you want to handwrite on it, so you handwrite their name and their address to make it more personable, as if someone gave them a card. And then on the letter itself, you're going to handwrite call to actions. So it'd be like, hey John, call me, and then you write down your phone number on the piece of paper and you sign on off on it. So that's what I've done to be really successful with direct mailers. I mean, I'm sure all of you seen it in the mail where some guy just sends you some postcard and it's just some broker in like a suit. The first thing I do when I see it is I throw it away, right? But with the letter and the way we structure the lettering campaign and how I teach the students is it's a very personal letter. And that's what one of my students, he started his direct mailing campaign, and like an owner called, like he's doing it in Texas, and an owner called back and said that, man, your letter was so like relatable and like just touched my heart that like I want to help you. I want to see you succeed. Like this is a real estate apartment owner who wants to help my student because the letter felt so touching. So that's how I kind of do it. And you know um, the other part too is like lettering. The point of the letters is to get them to call you, right? But then after they call you, that is the hard part. That's how you build trust, right? How do you build trust? Because you're completely a stranger, right? I sent you a letter. I'm some stranger in California. I'm a pharmacist stranger in California. How are you gonna trust me when you're in Oklahoma? So the key is building trust and rapport of that owner. So in my course in the mentorship, I have like this interview form where it's like I think 10 or 12 questions where you talk to the owner, and the point of the first conversation isn't really to talk much about the property. It's really just to get to know the owner and build trust. So my first question, icebreaker, is hey, tell me about the property, like, or tell me how long have you owned the property, tell me something about it. And all real estate investors love talking about real estate, right? I'm no different. I love talking about my real estate, right? Especially if they owned it for whatever, 20, 30 years. It's like a little child for them, right? They're talking about their child that they've had for 20 years. So they brag about it and they love talking about it. And in a weird human psychology way, you just need to sit there and listen to what they're saying. And then whatever key nuggets they give you, just summarize it, repeat it, summarize what they said, and then add a piece of nugget that complements them. That's how you build trust and rapport, right? I learned doing this in management. I'm a pharmacy director. So this is what I do on a daily basis at work. So It's just building that trust and rapport. And at that point, you ask other questions to figure out what their pain points are, right? So like, oh, like why are you looking to sell? Like, do you want to retire? Like, did you have a divorce and you have to unload the asset? Did maybe your dad was managing the property and he passed away and the kids don't want anything to do with it? Maybe you're self managing it, you just want to retire. So like you gotta know what their motivation and their pain points are, right? And you structure your offers and your career financing based on those pain points, right? So obviously, if it's a divorce, I mean, divorce is very emotionally taxing, right? And the last thing they want to worry about is like getting rid of it. So for them, speed matters, right? They want to know that you can close fast, and that they may be more willing to work on price with you, right? Or if it's retirement, maybe they became disabled, right? Like maybe wherever they got in a car accident and now they can't manage it and they're just focused on their health, so they just want to get rid of it, and but maybe they still want monthly income. So at that point you want to do some seller financing or subject to, so they get monthly cash flow without the day-to-day operations. Number three is retirement. When I talk to them, when they tell me they want to retire, I just say stuff like, you know what, like I look up to you because like I hope to be at your level one day where I own this real estate for 20 years and I'm selling it to retire. That's the ultimate goal. That's the dream of real estate, right? And I want to help you retire. So let's make something happen. Let's create a win-win situation, and let's get this done so that you can retire and spend time with your kids and move to wherever you need to go, right? So a lot of it is just talking to them, building rapport, and figuring out what those pain points are, and then structuring your offer based on that pain point. And when you talk to them, that's how you do it. So that's how I've been able to close on my deals, to be honest, is just being very personable and getting them to like you. That's ultimately what it is. And in a lot of the markets that I invest, I'll be honest, like there's not as many Asians there compared to like California. So that's another uphill battle that you're gonna have to combat, right? So like, how am I gonna trust you? So um, let's see. Hopefully that answers your question there. Any other questions? I guess I'll just open it up to anybody. No, no questions. Quiet crowd. So I guess since we have a little more time still, I can just give additional pointers about. Oh yeah, go
I
ahead.
have, I have one. We belong to Sears, and there's a lot of fractional deals going on. What's your opinion? Put money into projects, a syndicator, and do nothing with it, or are you still advising in this recession to still get your own building? What's the better strategy?
Oh, sorry. My audio cut out a little bit. Can you repeat that one more time, Jenny? Sorry about that.
So, no worries. My question was, there are syndications out there, right?
Yeah. Oh,
Syndicators,
yes.
fractional, and all of those. In this recession, what's better? Do you put your money into the syndicator and just kind of sit and wait, or do you still advise people to go out and get their own, buildings or quads and triplex and or commercial apartment buildings? What's the better strategy?
Yeah, that's a great question. So it's kind of two pronged in my mind. So so when you invest with a syndicator, what you're doing is you're trusting this operator, right? That they can get deals, that they can manage it, and it's more passive. It's hands off, right? So in my mind, like if I were to invest in a syndicator, that means that I, in my mind, should be very wealthy, and I'm free of doing the day-to-day operations. So you're basically paying someone to do the work for you, but your return's not going to be as good, right? And then you don't have as much control over the asset, because if the syndicator decides to sell, then you get your money back, right? Or maybe on top of that sum. So me personally, I'm slightly biased, so I'm not a big fan of the syndication model. Um, Personally. I don't, at least right now, don't intend to syndicate, and I don't really like syndicating in investing in syndications because I just feel like I lose control Like for me, I invest in real estate because I want control, right? Like I'm a buy hold investor, but if I give my money to a syndicator, I'm at the mercy of their plan, right? And the plan can change, right? They can say like, "Oh, we want to hold it for whatever 10 years," but something might happen. They're forced to sell, right? Um, so for me, I personally would probably stay away from that unless, like I said, your situation is you just have a lot of money. Maybe you're so focused on like a business that you have, and you just don't have the time or capacity to invest in real estate yourself. At that point, yeah, maybe syndication is better, right? Because I hit that personally too. Like with 90 units and doing three value adds, I hit my capacity. I'm not fortunate enough to have extra money to invest right now, but like I hit my mental capacity. So maybe the next one, maybe it might make sense to me invest in syndication, or I just can hold on to the money and have more reserves for when my deals finish. But to do your deals, I'm pretty a big advocate for doing your own deals, and I like 5+ units because you get the commercial loans, so it's based on the net operating income divided by the market cap rate. So I'm a big advocate for like the medium sized apartment complexes. So that's about 20 to about usually 60 units. That's a sweet spot where like you're not competing against single family home people, but then the syndicators aren't going to go after those like smaller apartment complexes because um, they need more fees and whatnot. So yeah, that's just kind of my sense. So, like for me, you can never go wrong if you buy your own real estate, do a value add strategy, you force appreciation, and do a cash out refi, and you repeat that model. Like you'll never go wrong with that. Um, but like I said, with syndicators, like I would honestly, like me personally, I would only use a syndicator that's been through multiple market cycles. Like you're talking about 2000, 2008, right? So like a lot of investors, including myself, like I'll be honest, I only started in 2017. So it's always been a bull market, right? Like this is the first recession that I'm dealing with, right? But a lot of the syndicators that I see, they just started in the past 5 years too. And you can make bad mistakes, but since the market was just surging like crazy, it covered their mistakes. But now with the recession coming, like this is when you weed out the good syndicators versus the bad syndicators because the bad ones will get wiped out. The good ones that have been through multiple market cycles, they'll know what to do because they've been through it, right? So I just would caution that if you do invest in a syndication, then use someone who's been through multiple cycles. Um, Instead of someone that's newer. So that would weed me out, right? Like let's say I was trying to syndicate. I haven't been through multiple cycles. So I would even invest in my own, syndication if I had one. So that's what I would do. Or if you do it yourself, then just get small multifamily and make sure that I would probably invest in a cash flow market. Like what I'm doing in Oklahoma, it's a cash flow market versus like California, it's more of a, it's not as much of a cash flow market. So that's kind of my kind of philosophy overall in terms of doing that. Because like I said, I'm a buy and hold investor, and I just don't like um, to lose control of an asset. If that kind of makes sense. Um, yeah, hopefully that answers your question there.
Yeah, I kind of agree with you on that. I just wanted a different perspective. Sometimes you think about what, let's say you're a small startup and you just have 50,000. Do you put it in syndication and trust somebody blindly, or do you do some sweat equity like you've been doing? So it's just it's hard, right, for someone new.
Yeah.
So thanks for your perspective.
Yeah. No. Like yeah. Someone like asked me because like a lot of people like they'll ask me like how much money do you need to get started? It is large, right? Like I typically say like 200, 300,000. Especially if you're funding your down payment, and I'm buying in Oklahoma for like 500,000, but you still need about 125,000 down, right? 25% down plus another 100, 200,000 for renovations. So that's 300,000. So yeah, obviously that's no easy feat, right? Especially for someone starting new. But like to me, I think it's like honestly, if I had $50,000 starting off, I would invest in like I'd take some of it, invest in some education, right? So like like for me personally, that I joined a mentorship, and then it cost me $15,000, but just on my first apartment alone, I'm probably gonna make close to $1 million. right? So like I spent $15,000 to learn, and now I have the strategy to make $1 million. So I think investing in yourself, and then obviously just put yourself around the like-minded group to learn from, right? So that's what I'm hoping to do. Is just having people like-minded doing what you're doing, and putting your money where your mouth is, because a lot of people that I talk to that want to get into syndication, that don't own multi or apartments yet, they're just thinking like, oh, like I don't have money, so I'm gonna syndicate, right? But that's the wrong mindset to have, because like, imagine like I gave you my last $50,000 and that's all I had. That's my life savings. Like, who you think is gonna be the most pesky investor that you have? It's gonna be the guy that gave you their last $50,000 and they're stressed out about it. So for me, by the time I syndicate, whenever that is, I want to be like have such a good track record of my own portfolio that I just want to attract people who are like just ultra wealthy, that they just give me like a couple million. They're like, yeah, just do whatever you want with it. I'm not going to bother you. Like that's the level I want to get to. But I feel like I can't get there yet. So, like I said, $50,000 sounds a little, but if you do creative financing, sometimes you can get 0% down. Like I've seen it. I've seen people get 0% down, or maybe you do 5% or you do 20% down, but you break it up 5% at the close of escrow, 5% year one, 5% year two, 5% year three. And if you buy it right, your cash flow will save up enough so that it covers the 5% down the road. So, there's so many creative strategies that in my mind, I think even without much money, you can still get apartment complexes. You just have to learn and master creative financing. It's even more important at that point, right? Or you can um, get good deals and wholesale them. So you can like I could have easily wholesaled my apartment complex for $100,000 more and made a assignment fee of $100,000. So now I have $100,000, and now I can wholesale a couple deals, build up my down payment, and then go buy my own apartment complex, right? So that's the way I kind of think. Like it's not like, oh, like I don't have enough money, I can't do it. It's like, how can I do it, right? And I just described a couple strategies on how to do that yourself. So still a big advocate of doing it yourself, regardless of how much money you have. It's obviously a little easier if you have you know money saved up, or like a lot of my students, they just have equity in their single family homes, and they just did a cash out refi, or they pulled a HELOC on their investment property, and they're going to use that to buy the next apartment complex, right? Do value add, pull your money out again in like 1 to 2 years and buy another one. And then you'll be surprised in 10 years, you can easily scale from 0 to 100 units without any partners, with very little money, right? So just getting that first deal, and that's what creates that snowball there. So that's kind of my perspective. I know I'm a little bit hard on syndicators and brokers, um, but that's just kind of been my experience, with a lot of syndicators. Um, and there's quite a few of them on the forums there. So yeah, great question. Great question. Any other questions? We got time for like one more. No? Okay, then I just will end with, I guess, kind of my final thoughts. Um, so kind of like something that someone told me that stuck in my head for a while is you're married to your purchase price, but you're dating the interest rate. So basically, to me, like I don't really care what the interest rates are, like because you can always change that, right? Just like dating, you're not fully committed. You can just move on, right? Versus when you're married, you're committed to that long term. So like to me, the purchase price is the most important. Interest rate can be like whatever, because like I said, we're gonna do cash out refis anyways. Whenever the rates go back down, just cash out refi, right? And you might have maybe pull out some money and do more. And then, so for me, like I kind of like the uncertainty, because that's when people get desperate. And then if you can pounce on this opportunity, this is when you can really scale your real estate portfolio. So to me, this is like the golden opportunity. I always kind of jokingly said, like, oh, I wish it was a 2008 so that I can do it. But I will admit it is stressful, right? Like I saw my stock portfolio go down, and I'm not as confident, right? If your stock portfolio goes down by like a couple 100,000, you're not as confident anymore. If your primary residence goes down by a couple $100,000, you're not as confident. But if you can bypass all of that and have the right mindset and be surrounded by the people who are still buying real estate, it's motivating to see, and it helps keeps you active, right? So even seeing, some of my students, get deals and whatnot, it's motivational for me, as well, to know that, hey, it's still doable regardless of the market conditions. And it's proving it. So, um, if no other questions, then thank you everyone for hopping onto this call. Like I said, if you have any questions about the course, just shoot me an email. And I post YouTube videos. So this session gets uploaded every Wednesday. So after the call, I upload it, and then I have other videos where I talk about other topics. Upload every Saturday. So check out the YouTube if you want to see those videos. And I have a more detailed video about my direct mailing campaign. So if you go to my YouTube channel, you can watch that. I did one whole session talking about how to set up your direct mailing campaign, and I think I showed my letters that I sent out actually too. So check those out. And like I said, if you want my referrals to PropStream or Yellow is Complete, just let me know. I have my contact who helped me set my letter, so they know what I'm doing, so they can help you do what you're doing. Or if you want to emulate what I'm doing, they'll help you do that. If not, that's
Sounds
it.
good.
Well,
Thanks, Steve.
thank you both. Thank you so much.
Bye.
Bye bye.